Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, happy new year. The start to the year that we seem to have had is that the currency is very much in focus after sort of not really being something we pay. We do pay attention to it. We don't pay a huge amount of real detailed analysis to it because normally it does sort of just move along. Yeah, there's a little bit around how relative interest rates go and, demand and supply and how export prices and that emerge, sure. But at the moment, we've seen that the New Zealand exchange rate with the US dollar has come down nearly 10% from where it was in September, and has, fallen a bit more, certainly at the start of January 2025. We're now talking, I think last that I looked was at about 56 cents. It had traded at 55. You look back, through parts of 2024, and it was trading above 60 US cents to the New Zealand dollar. So it has come down quite a bit. Of course, a lower exchange rate, lower New Zealand dollar is better for our exporters. They're able to effectively make more money, which is good news for them. But it does mean that those imported goods are costing us more when we're bringing stuff in. And if I was heading away for a US holiday, I'd be paying quite a bit more. I mean, what's driving this sort of quite big devaluation or fallback in the New Zealand dollar? Because it is unusual. It's now testing, I think, lows that we haven't seen for a couple of years.
Yeah, I mean, you look at it and it is primarily a US dollar story. There's not as much weakness coming through against the other currencies such as the yen or the pound or the euro. It is very much being driven by expected economic strength, I think, in the US, both in terms of some of the partial indicators coming out, jobs data, for example, and there's a bit of concern about inflation lingering over in the US. And that's feeding through both into expectations of stronger economic growth in some respects, or that has been the message that has been coming through, but also the Fed's reaction to that going forward from here, that they may well not cut interest rates as far or as quickly as they had previously signalled or as markets had expected as well. You combine all of that alongside the election of Donald Trump as US president and expectations around his policies being stimulatory or favourable for big business and therefore leading to faster economic growth potentially later this year or into 2026. Markets have taken all of that together and said, you know what, we're willing to bet on the US economy, we're willing to bet on the US dollar, and it has been reflected in that greenback rising pretty much against every currency out there, and New Zealand has been no different. But it is quite, we were sitting at 60 cents for quite a while through much of 2024. So there has been a big shift there, which does, as you say, have inflationary pressures and consequences potentially for New Zealand, both in terms of imported prices, but also stuff that we send overseas in terms of milk, and you've seen that rising in the supermarket, again, as a result partly of the exchange rate, partly as a result of higher commodity prices. It shows through in terms of meat and some of the other export categories as well. So you put all of that together, and particularly when you've taken into account something else like fuel as well, where obviously, look, oil prices have been pushing up in US dollar terms, and that's been doubly more expensive for us Kiwis as well as the currency has weakened. And the reality is the currency is getting close to a point now that it hasn't been back since back about 2009, 2010 in the wake of the global financial crisis. So it is at, we're talking close to 15-year lows if it drops much lower than that sort of 55, 56 cents that you've been talking about. So I think real concerns there around what it might do for inflation and I guess flow-on effects as well, therefore for monetary policy conditions and interest rates in New Zealand. So, it is starting to just affect our thinking of what the Reserve Bank might do through the course of this year with interest rates.
Well, and that's the interesting thing, right? You look at the US economy, and part of the reason that there's has been such good economic trends going on there that if you've got some money to invest across the world, you're probably going to put it into the US, because it's having those better results, better outcomes, better returns. In fact, I think the gap between sort of where US stocks are and European stocks are has got its widest gap since ever. And so again, with such demand for people wanting to buy US stocks, you need US dollars to do that. So, some of it is just sort of a simple supply demand element around the currency. But I think as well with that, you're starting to see it. And what got me was in recent days, you saw that sort of stronger jobs report that came through, like you discussed. One of the US banks, Bank of America, said, hey, look, we think the Fed's done. No more cuts. Next move might actually be a hike. But what really got me was the fact that the University of Michigan survey around inflation expectations was showing its highest long-run inflation expectations since like mid-2008, 2009. And it did just suggest, again, there's a little bit more perhaps inflationary pressure in the system that might linger globally. And if we're now paying more for our imports, then any imported inflation we're bringing in is sort of more inflationary than we might have first expected. So definitely a little bit of concern and risk around there. You mentioned interest rates and monetary policy. I mean, for the Reserve Bank, they gave a pretty strong, very strong, probably the strongest view we've ever heard from them in terms of, hey, got a decision coming up in a couple of months. It's going to be 50 basis points. Thank you very much. It was pretty strong in terms of tone. And I think we all, as forecasters have adjusted our expectations around that. But it does also, I mean, the Reserve Bank has been picking a bit more tradable overseas imported inflation coming through. So this is not completely outside of expectations, but it's making us, I think, a little bit cautious. I mean, how does the Reserve Bank respond to that, and what else are they watching? Because it's not just the currency that will influence this decision.
No, you're right. I mean, look, they were expecting tradable prices to push back up a bit this year after we saw falls through 2024. So, like you say, there is a bit of a slack in the system, or expectation there that would come through. But the reality is, with the exchange rate being significantly lower than they were picking on a TWI basis, and particularly against that US dollar, and with oil prices also just pushing up a bit, again, more than expected in international terms, those just will weigh on the Reserve Bank's thinking about, well, we know there's still pockets of domestic inflation that they were worried about and looking to get on top of. Maybe not stuff they can necessarily influence, but it does sort of colour their overall inflation picture on the non-tradable side. So you add in a bit more of a problematic tradable side to inflation, and you look forward and go, well, yeah, how much further can they cut? Even if they do 50 in February, can they afford to cut 2 or 3 more times after that? Or are we getting closer to the end than they thought? There is still obviously a lot of data between now and their next decision in about a month's time. Particularly big data series for them, of course, will be inflation for the December quarter. That'll predate any of this exchange rate stuff. So it's only a bit of a partial picture, but at least we get to see how those underlying pressures are developing. And also the labour market as well. We've had some job numbers recently, which just showed possibly a little bit less weakness rather than more strength, I think, in the monthly job figures. Job ad numbers look like they're possibly levelling out as well, albeit at a very low level. There's still not a lot of appetite for employment at the moment. But yeah, just how that labour market is unfolding as well, given that there was still further weakness expected to come through in that, and reflecting weaker economic activity through the first half of this year, which would have made the Reserve Bank more comfortable with cutting. So again, those are probably the two aspects that they will be looking for, or the major pieces of data they'll be looking at, alongside what is happening with the exchange rate and some of those other international indicators as well.
Yeah, a tricky decision for them, but like you say, a lot of water to go under the bridge before, I think any of us are comfortable making a more definitive call. I think importantly, look, we can't really battle this exchange rate coming down and the currency dropping lower. You're right, it's less a New Zealand weakness story and more of just a US strength, and that's why you're seeing it reflected in all of the various currencies across the board. And it's not the sort of thing that you can easily fight. But what might weigh in on the Reserve Bank's thinking is less around fighting it and more around how much we then get out of kilter. If the US Federal Reserve is sort of, plateauing out, maybe not needing to cut quite as much, you've seen big increases in US 10-year bond rates as well, and those expectations of actually maybe some higher borrowing costs in some areas. Then for our Reserve Bank to continue to cut drives quite a wedge between those sort of two expectations, which could exacerbate things. So they might well go, well, look, based on all the other data, maybe we don't need to go quite as gung-ho and split that wedge quite as wide. But a lot of water to go under the bridge, still a lot of data to take into consideration. We'll continue to assess how all of that goes, including what happens to the currency next, and if it tests any of those sort of, decade plus lows on one of our future editions of Econ Talks.